Here's a riddle for you. When is a dollar not a dollar? Now it's true that this $20 bill will always technically be a $20 bill, but the amount of things that this $20 can buy varies over time due to a concept called either inflation or deflation. In most countries, the cost of goods is constantly going up, and that's due to inflation. But a more accurate way to look at inflation is not to say that the cost of goods is going up, but rather that the value of the dollar is going down. In America, inflation typically happens at a rate of roughly 2 to 3% per year. And that means that this $20 bill will buy me $20 worth of stuff today, but next year it'll buy me roughly 2 to 3% less stuff. I won't be able to buy the same quantity of stuff a year from now, or 10 years from now, or 100 years from now. If you've ever talked to your parents and they've told you some of their old stories, I know my parents always used to talk about how they could go down to a restaurant and buy a hamburger for a quarter. Now I can't buy anything for a quarter. Like if I go to McDonald's and try to buy a Big Mac, it's going to cost me probably at least $5. But when they were growing up, a hamburger cost a quarter. And for them, a gallon of gas was 27 cents. Whereas today it's, $2, $3. And that's inflation taking over. Back in those days, 25 cents was a fair amount of money. It was a good enough amount of money in order to buy you a hamburger. Whereas today, that's going to cost you $5. The value of that 25 cents has gone down significantly. Where it used to be worth a lot, now it's not worth anything. Now you need at least like $5 or $10 to buy most anything. And one of the reasons that inflation exists is that the Federal Reserve, the government, can literally just print these dollar bills whenever they want. And they do. They print new bills all the time. So as new bills are printed and the total supply of money keeps going up and up and up as more and more bills are printed, basic rules of supply and demand says that as the supply of money goes up, the demand for that money will go down. The value of that money will go down. Now, when the government's doing their job and they're operating efficiently, then they can usually regulate the rate of inflation and keep it pretty consistent so that we have a nice, steady economy. 2 to 3% isn't that bad. But what happens when things go crazy? So imagine that you are living in the country of Zimbabwe, and you were going to go to a store and you were going to buy a loaf of bread, and let's just say that loaf of bread cost $3. But you were a little bit lazy today, and so you decided to go buy that loaf of bread tomorrow. And so when you get to the store owner says, no, you can't have a loaf of bread for $3. $3, that was the price of the bread yesterday. Today, I want $300 for a loaf of bread. And so you're all pissed off. You're like, what in the world? Why do I need to pay $300 for something that only cost $3 yesterday? And so you storm out of the store and you're all mad, but realistically you gotta eat. So you go to the bank and you withdraw $300. You're gonna go back to the store, but it's a little bit late. So you end up going to bed and you're just gonna go back in the morning and buy this bread. And so you wake up in the morning and you've got your $300 and you're heading back to the store and you're still pissed off from the day prior. Like, why do I need to pay $300 for a loaf of bread? This is crazy. But you get to the store and you get to the checkout lane and you're trying to pay for your loaf of bread, and the store owner's like, sorry bro, can't sell you a loaf of bread for $300. That was the price yesterday. Today, it's gonna cost you $30,000. And if that sounds crazy, well, it is, but it happened. The country of Zimbabwe experienced roughly 79 billion % inflation month after month after month. The value of their dollar was essentially garbage. So basically what the government of Zimbabwe had to do was they had to keep on printing higher and higher denominations of bills to keep up with this hyperinflation. And it got so bad that they actually printed a $100 trillion Zimbabwe note. And if you were living in America and you had 100 trillion American dollars, you would be filthy stinking rich. You would be by far and away the richest man in the world. But $100 trillion in Zimbabwe wasn't very much money. In fact, it was only the equivalent of roughly 10 bucks in America. Like, everybody in Zimbabwe had stacks and stacks of these $100 trillion notes. There wasn't anything special. In fact, it got so bad that Zimbabwe had to get rid of their currency altogether. They just stopped using the Zimbabwe dollar because nobody wanted it. Inflation essentially made that currency useless. And so this hyperinflation can be a very scary concept. Now, where this applies to us is the national debt in America is roughly $28 trillion. That's a lot of money. In Zimbabwe, that would be nothing, but 28 trillion American dollars, that's a boatload of money. And the problem is, America has no realistic way to repay this debt. So at some point, what are we going to do about this debt? Well, the only thing that can realistically happen is inflation kicks in and the government just starts printing more and more and more money. I mean, theoretically, they could just turn on the printing press and print $28 trillion overnight and then just pay off their debt. But obviously, if the government did that, they would dramatically increase the supply of money, and the existing money, the value of that, would go down to almost nothing. It would cause hyperinflation. So for that reason, a lot of people think that there's going to be high levels of inflation coming soon in America. Now, some people can benefit from inflation, while some people can absolutely get destroyed by inflation. So here's two different scenarios. Scenario one, you owe $10,000 in student loans, and that might be a lot of money for you. You're having a hard time paying for that. But what if inflation kicked in and now $10,000 was not a lot of money? Like, what if now, instead of making $7.25 as minimum wage, what if inflation kicked in and everybody was making $100 an hour? Well, in that case, it wouldn't take you but just a couple of hours at work to be able to pay off your entire student loan, and now you're technically debt-free. So for anyone that's in debt, inflation can actually help you because the value of that debt suddenly plummets down to almost nothing. But on the flip side, let's say that you're somebody that saved your entire life, you're old, and you're getting ready to retire. Maybe you've saved up $100,000, $500,000, $1 million, whatever it is that you worked your entire life for in order to actually retire. But what if that $1 million in your bank account suddenly became almost worthless because now everybody had $1 million? Now that $1 million in your bank is only going to buy you as much as maybe $100,000 would have bought you just a few years ago, because now everything is super expensive. So if we assume that there is going to be higher than average levels of inflation in America in the next handful of decades, what can we do as investors in order to properly prepare ourselves so that we don't have our entire net worth just wiped out? Well, there's a couple of different options for investors, and one is to invest in some sort of commodity that typically retains its value. Now, over the years, gold has typically been that store of value. The price of gold typically keeps up with the rate of inflation. It's something that will always be in demand regardless of how in demand the dollar is, or the peso, or the ruble, or the franc, or whatever currency denomination you're talking about. Gold will always be in demand. So gold is a great store of value against inflation. Now, some people will say that Bitcoin is the new gold, it's sort of the digital gold, that Bitcoin's price will also keep up with inflation. And maybe it will, maybe it won't. Bitcoin hasn't really been around long enough to really be a tried and true investment model. It might be great, or it might be one giant scam. So invest at your own risk, but there are plenty of other good options in order to protect your money against high levels of inflation. In fact, the government itself has a system set up for you that you can protect yourself from inflation by investing in a certain type of bonds. There's a type of bond known as TIPS. It stands for Treasury Inflation Protected Securities. So hypothetically, if you bought a $1,000 TIPS bond, and then there was suddenly a 10x inflation rate, that $1,000 bond instead would now be worth essentially $10,000. Plus, they're also going to give you a trivial amount of interest on top of it. So in this case, if you're buying TIPS bond, the value of that bond will be adjusted on a yearly basis based on the consumer price index. How much inflation existed from last year to this year, and the face value of that bond will then go up effectively by that much. If you're interested in buying these TIPS bond, you can just go to treasurydirect.gov. It's the government website, so obviously it's not an affiliate link or anything like that. But if you're interested in buying some of these TIPS bonds in order to protect yourself against inflation, that's where you'd go. And potentially the best way to protect yourself against inflation is real estate, because real estate, more often than not, is leveraged debt. And so you can take advantage of that leveraged debt, and it sort of amplifies your investment gains when it comes to high levels of inflation. So think about it this way for a moment. Let's say that hypothetically you go out and you buy a brand new house, and that house, let's say, costs $100,000. Let's just keep the math simple. And let's make it super simple. Let's assume that you put 0% money down. So you financed 100% of this house. So you own the house, but realistically the bank owns it, right? Like they financed the entire thing. You didn't put down any money. And now let's say that inflation kicks off here in America. So instead of the normal 2 or 3% inflation rate that we normally have on a yearly basis, what if instead the price of things suddenly doubled in the course of 1 year? So now a gallon of milk isn't, $2 or whatever. Now it's like $4 or $5. A gallon of gas is like $5. A Big Mac is $10, etc. So if everything doubles in price, then your home will probably double in price too, or at least roughly. So now your home is suddenly worth $200,000. But remember, your loan is still only for $100,000. So now suddenly you own half of the total value of the house. Whereas a year ago, you didn't own any of it. The bank owned 100% of the house. But now thanks to inflation, you have suddenly gained a lot of equity in that home, and you own half of it. And that's one of the reasons why I love investing in real estate. Now, don't get me wrong, I've always loved real estate. Over the course of human history, real estate has probably made more millionaires than any other asset class combined. It's always a great investment. But if you think that there's going to be high levels of inflation on the horizon, then real estate can be even a better investment, because that inflation will essentially destroy all of that debt, that mortgage that you have on your house, because the value of your house will be adjusted for inflation, but your debt will still remain the same. If you found this video useful, be sure to subscribe, leave a comment down below, give it a thumbs up for the YouTube algorithm, and as always, I'll see you all again next time.